Hey everyone, Cotton Candy TA here. Welcome to Beginner's Course Part 7, Wedges. Alright, if you're enjoying the content so far and haven't subscribed to the channel yet, go ahead and subscribe. If you do want to support the cause and you want to support what I do, you can find the donation details in the video description. And if you haven't checked out the Twitter and TradingView account, I would suggest you do so, as I post up my trades there daily and my content and scheduling and so forth. So yeah, let's get right to it. Alright, what are wedges? Wedges are kind of the kin to trends. We learned about trends in the last video and how kind of these trend lines like this form support and resistance. And if you haven't watched the last video on patterns, it discusses patterns and trends, it'd be pretty important that you do so at this point, just because you're going to need to know that material before kind of fully understanding what wedges are and how they kind of play together and the role they share, right? So we talked last video about trends and patterns and how patterns kind of appear all the time in the charts and they repeat themselves. And wedges are kind of the same thing. Wedges are, like I said, they're akin to trend lines, because what they are basically is trend lines with tops and bottoms, right? So something like this, right, would be a wedge. You guys kind of see these all the time. They are on charts all the time. They're labeled as valleys, as peaks, as ascending wedges, descending wedges, bear flags, bull flags, all sorts of different terminology for wedges. And really the important thing about wedges is not, remembering the 20 or 30 different types of wedges there are. You remember that this type of ascending wedge maybe has a certain pattern that it goes by, and because it's ascending, it's going to break out a specific way, and you can kind of break your brain almost trying to figure out all these 20 or 30 different patterns that there are, and kind of trying to build this muscle memory of patterns with wedges, but really that's not going to do you any good, because wedges are simply just trend lines, right? Wedges are simply just these creations of trend lines, right? When you have something like this, where you have the swing high of a move to the next swing high of a move, or down here, swing low of a move to the next swing low of a move, and these trend lines and patterns. So the important part about wedges, before we get into going through discussing what they are, is to just kind of let go of all the patterns and all the memory recognition you guys have built up from this point on, because we are going to understand the wedge differently. We are going to understand the science of the wedge and why moves happen within wedges. So take it out of your brain, take it out of your mind, destroy that catalog of ideas you have about wedges and memorizing the patterns and all these things like that. It's not going to do you any good, right? We are going to understand wedges and how they function on the charts, instead of trying to memorize patterns, because memorizing a pattern isn't going to do anything for you guys. So what purpose do wedges serve? So I am going to bring up one of the charts that I did. Now, this was self-key, and this is an entry I gave on my TradingView account. When was this? This was on October 18th, by the looks of it. Yep, on October 18th. So I identified a wedge that was in key, and the purpose of a wedge is wedges show you the same thing trend lines do to a point. They show you kind of trend reversal or a breakout of a move happening. When a wedge breaks, when a long-term wedge breaks, they show you a breakout of a move. So it's either going to break up or it's going to break down, right? So the purpose of wedges are to see kind of these boiling points where accumulation or distribution is happening, and this boiling point of where once this wedge breaks, this move is being forced in a direction. So let's just hit play here and see how this went out. So when I posted this up on TradingView, let's see play and see how this trade played out. I'm going to turn this off. Whoops. All right, let's bring that back up. Let's hit play here. So you can see that this was quite an insane move on key, and the reason being is it broke out of this wedge, and once it had the power and the momentum to break out of this wedge here, it just went on this rampage up. It took this huge upswing, and let's look at entry down here when I signaled it. So entry down here would have been at 88 sats, okay, and the top of this move was at 154 sats. So let's say you got into this late, you got in at 90 sats, and you didn't quite sell the top. Maybe you sold at 150 sats. Maybe that was the level that you chose. From 90 to 150 is 60 sats on a 90 sat coin. So you're talking about a 66% gain on one stock, just because you were able to identify a wedge and see the breakout that it's going to take after it breaks out of that wedge. You know, even round down, maybe you didn't make 66%, maybe you made even less, maybe you made just 50%. 50% is insane. 50% on one player, one coin, or one stock, or one trade. 50% is insane. 40% is insane. 30%, 20%, even 10% is great on one trade. So really understand that wedges have a power to them, and the power of a wedge is they show large moves in the market. And if you can spot them, you can almost predict what's going to happen based on, you know, levels of support, trend lines, you know, all these things we learn in the past, all these pieces that we're building upon. You can almost predict the outcome of these trades on a regular basis. So if you haven't watched the videos that we've uploaded so far, that I should say that I've uploaded so far, lesson 1, 2, 3, 4, 5, and 6, it's paramount that you guys understand those concepts in great detail. So like always, we use every lesson from the past to build the blocks of the future, just like building a Lego castle or whatever, the sand castle, or whatever kind of castle you like to build. That's what we're doing here, right? So it's important that you know that you focus on understanding those concepts in great depth, because all these things that we teach are very context rich. Understand them in great depth every time we go into one of these new videos. Okay, so accumulation and distribution in wedges. Let's go back to our charts. So there's an interesting thing about wedges and trend lines, and you see this in trend lines as well. And you know, wedges serve the purpose of completing trend lines, right? Like when you have a trend line, say from this swing low to this swing low, right? Or you have you know, this right here to this right here. You know, these trend lines, they create your wedges, right? So actually it would be, whoops, let's get back out of there. Let's just pick this tool back up. You know, if you were to create this this trend line here, from this swing low to this swing low, and from this swing low to this swing high right here, right? Basically all you're doing is creating a wedge. So these, whoops, so these trend lines, right, all they do is create wedges, you see? Trend lines and wedges are you start with trend lines, and your trend lines develop into wedges, and trend lines are important because a wedge is going to show you one part of that support and resistance, and the trend lines are going to show you another part of that support and resistance. An example would be here, right? You know that this is going to act, right, as resistance. We know that this trend line that goes up like this, right, once we break under it, we know it's going to act as resistance. So that's where the trend line comes into play, and that's where you need these trend lines on your chart to kind of continue on. And that's a little different than a wedge, because a trend line, although a trend line and a wedge share the same hard left and hard right edge, as you can see here, right? They share the same hard left and hard right edge. The difference is a trend line is one infinite line that acts as support and resistance as you move in this coin, right? A wedge shows where that's going to break out. So it's a little different, right? And a wedge also has a top side. Trend lines don't have that top side. They do, but right, if you were to create this top side here, swing to swing, trend line, well, what do you have? You have a wedge. So it's easier to use the idea and the tool of just creating these wedges, because wedges also, for another reason, wedges evolve, right? You have your trend lines, but wedges evolve. As you make new swing highs and new swing lows, wedges move with those swing highs and swing lows, right? Like you have a swing high here, swing low down here, so let's line it up and see what happens, right? You have a swing low, swing high, break out of the wedge, take a huge move up. So that's where trend lines and wedges differ a bit, is because a trend line is kind of this static force that sits there on the chart, as to where a wedge is dynamic. A wedge moves as a coin moves, the wedge moves, right? So I've picked Dent for this example because I've had a couple people say to me that you know, there's these low you want to call them penny stocks, or these low liquidity coins, or low value coins like Dent, where Dent is only a handful of sats, right? We're, you know, between this range of 23 sats to 59. And people think that because these are these penny stocks, we're going to call them, or these low liquidity coins, or low value. They're not low liquidity, they're low value. It's a mistaken term I use there. It's a low value coin. Because it's a low value coin, people think that they have kind of this ignorance to the market, or they ignore the market completely because the buys and sells are just so high because of the value and the way the books are set up. But it's not. I want to show people that that's not accurate, and that these charts still they still stay true even to low value coins. It's just being able to spot that out, right? So we are going to use Dent for these examples. Okay. And accumulation and distribution. Let's start building these wedges, and how are they different from trend lines? So we went over that, so we kind of skipped one, and what happens on a wedge break, and accumulation and distribution. So that's what we're going to go over here. So let's delete this, and let's delete this, and start from the beginning. Okay, now we're going to do something here. We're going to take this, and we're going to chop this chart right here, right? So we can kind of walk through how a wedge would be created. Okay, so when you're creating a wedge, you know you're going to have the swing high of the move. Oh, whoops, wrong tool. You know you're going to have the swing high of the move here to the next swing high, right? So you know you're going to have that there. And you could even, you know, pull it back to here. It would be the same thing. Or this swing low to this swing high here. You're going to find the relevance somewhere in there. You're going to use a swing high to the swing high. And you'll see that's the relevance of this. So as we step forward in this chart, just like trend lines, we know we have one swing high to the next swing high, right? So that's created right there. First we would have created on this, and then we would have found our new swing high, and we would have created it there. Now we are going to step through this, right? We're going to wait for our swing low, right? Looks like right there we have our swing low. So we are going to create from this swing low that started the move to that swing low, okay? And we are going to wait for the top side of this, which is right here. So let's recut that right here. Okay. At this point, you would have known you have your wedge, right? This is very simple, right? You can see how all we're doing is we're lining up our trend lines, and this would have been here as well, right? That would have been something like that. All we're doing is lining up our trend lines to the first swing low, which is right there. So accumulation and distribution. How does this work with wedges? Okay, so accumulation and distribution. You have different zones in a wedge that are accumulation and distribution. The bottom side of your wedge always acts as accumulation, and the top sides of your wedge always act as distribution, okay? So that is another spot where trends, although they are akin to wedges, they do share that idea of accumulation and distribution in points. These have 3 points of accumulation and distribution, right? So if you are to accumulate every time this touches down on this wedge, and distribute every time it touches up on this wedge, you can see that you would have had another accumulation right there. You would have had distribution right here. You would have had accumulation right there. And let's just walk through a little bit. Oh, looks like we're trying to break the wedge. So at that point, we would have probably gotten out of the trade. Now, there's something else to note that's very important about wedges, is that just like trend lines, they have kind of this breaking point. And this is a really important and advanced concept to understand, and it's not such a hard concept to understand, but it's very important in trading, is that in these wedges, right, you know that if you break out of this top side, you're going to go up. If you break out of this bottom side, you're going to go down. Or if you break out through the middle, you might enter accumulation and distribution, whichever one it ends up being for other reasons, and you know you have a direction that this is going to go off this wedge, and typically it's going to be up or down. It happens, but it's pretty rare that you go straight sideways. So something that's very interesting about wedges is, let's just put a line here, right? Let's mark out some levels, because I'm having a feeling that this is going to correspond pretty well. So we've got the Daily levels, we're going to turn these to red. We use red for the daily, right? The swing low and the swing high of the smooth. Okay, and then we've got the, let's put the magnet tool on, get it perfect. Then we've got the next level, which would be the swing low here, and the swing high of that. Whoops, wrong one again. The swing high of that, and then the swing high of the move there. Okay, so within these levels, we can see instantly our wedge was created off of that. Pretty basic. Now the importance of having these levels here is to understand that there's something unique that happens in wedges, and like I was saying before, it's an advanced understanding, but it is very important and crucial to know why these break, and all that has to happen is this price has to move sideways. So let's think about that for a second. We don't actually have to, if this coin was going to actually move down, and this coin was going to take this trajectory down through this wedge, the people who are wanting to see the price go down here, they're wanting to see it go lower, they don't have to push the price down, right? They don't have to constantly sell down. They don't have to constantly do that. All they have to do is sell at the current level until it ends up breaking. So it's a very important thing to understand with trend lines, with wedges, and as things are progressing, and you'll see where levels touch, wedge levels touch levels of support and resistance off daily levels, and you'll see these points where it's forced almost into an axiom or a point where there is no there is no reason for it to not break that level. And what I mean by that is it just goes straight sideways, right? So you can see here as we step through this, they don't have to push the price down. They don't have to do this thing where they're trying to smash the price down, because once enough time goes by, this price is just going to naturally break. They just have to hold the price, so that you don't even need downward pressure on this stock to break this price. It just breaks because it ends up going through the side of it, right? So let's walk through this and see what happens. Right? So we are in this wedge, right? Right now, we are seeing it's being supported. It tries to come up and break the top side of this wedge to gain that momentum, and it looks like it rejects off this level right here. So it looks like it doesn't quite touch that level, and it looks like it's going to break out sideways. And if it breaks out sideways, you realize that this is going to act as resistance then, and if that's acting as resistance, it's just going to go down, right? So what happens? Price does, it goes down. You see how it breaks out of the side of this wedge? It rides the bottom side of this wedge pattern until it just breaks out sideways, and just by naturally breaking sideways, it actually just breaks this level too, right? So it just naturally breaks sideways and forms a new set of moves, right? So it actually just kind of dumps there. And then this is where wedges get interesting. As wedges progress, wedges are different from trend lines, like we said before, right? If this was the trend line, if the trend line was kind of, you know, let's just, I don't know, it doesn't matter which one. We'll use this swing low to this swing low here. If that is the trend line, right? A trend line is a static element. It stays in place. It does not evolve. This does, right? A wedge now has a new swing low. It creates a new wedge, right? This wedge is constantly evolving, right? You see how it stays right in the middle of that wedge until it breaks that wedge and takes a move up. You see, once that wedge breaks, it takes its move. And at that point, it creates a swing low here or a swing low here and a new swing high. So these wedges constantly evolve, and as they are evolving, they are further moving the coin, right? These are the points as to where you will see action in a coin happen, is when these wedges are being broken, right? It's looks like it's right there, right? You see this wedge is broken and it's acting as support now because it broke through the top side of it, right? Drag this out. Let's see how this continuously progresses. Right? Because this is an evolving thing. Remember that. It gets supported by the wedge, right? It goes into another one of these pinching points, or another one of these crosses where these wedge points, the top and bottom, right, are acting as a cross and kind of the end of either accumulation or distribution. So let's look at that for a second. We know that every time we touch the bottom of the wedge, it's accumulation, and every time we touch the top of the wedge, it's distribution, right? So the same theory plays out here. We accumulated here, we sold here, right? Just like we did over here, just like you do all the way throughout this wedge. As this wedge evolves, you are using those bottom touches as accumulation every single time. So if you were to buy here at 30 sats and sell here at 39. And this is something that you could have very easily done. Take off one sat on either side to say, you know, maybe you got late entry or wasn't perfect or whatever. 31 to 38, what is that? 6 sats, 7 sats? So you've got 7 sats on a 30 sat coin. That's like 22 point something percent, or 23.3% or something like that. But you've got a 20% plus play because all you did was basically accumulated the bottom side of the wedge and distributed the top side, right? So now let's see where this goes after it breaks out of our wedge again. Breaks out. And it actually doesn't do anything. It actually goes into accumulation. So this is kind of one of those rare times. Now let's take this back to here and continuously pull our wedge with us, right? We are continuously pulling our wedge to our new swing highs and swing lows. And this looks like it's one of those times where it actually does enter an accumulation and distribution point, possibly, right? We have no swing high, lows, swing highs at all. But right there, we do get a new low, right? So then we would drag this out to here, right? Swing high, swing low, right? It's not really a swing high, but it's the new kind of the parameters of that wedge. Oops. We have a new swing high there, so we can drag it out. We've got our swing low here. That's our new swing high, so that's where that wedge would have been, right? So now let's see what happens here. As we break out of this wedge, you can see, and then let's just make sure this is lined up perfectly, because I don't want to get any information wrong here, or any, I want to get this exact, because again, remember, this is like the science of trading. What I teach is the science of trading and why markets move the way they do and the exacts of what happens. So just like this whole move, we know now, if before we go forward through this move, because I think you guys clearly see where this is going. Before we go through this move, let's talk about accumulation and distribution. Now let's look at this picture as a whole, because we've kind of analyzed it on a micro scale and zoomed in and evolved this wedge and pulled it out and done all that stuff that's showing us what's happening in the moment. But now let's look at this on a larger scale. Let's take our mind frame out of looking at the day-to-day and let's pull back to a month or two and what has been happening. Okay, what does this look like to you guys? This looks like it went through an accumulation zone right here. It then had a distribution zone right there and right there, right? Kind of two distribution zones, the very top and then the tapering off distribution zone. Let's delete this, and we're going to draw a box, okay? If kind of this point right here, right? If this point right here ended up being accumulation, right? Oops. If that point ended up being accumulation, right, in red, and let's make this one, I don't know, let's do yellow for this one, and this ended up being a distribution zone. What does it look like we are doing right now? Forget the day-to-day stuff. What does it look like the move has been doing for the entirety in this whole section here? This looks like accumulation, textbook accumulation with some small attempts to move up, and this looks like textbook accumulation. So let's combine a few of these different theories we have here. Accumulation, what happens after accumulation? A move up. What happens after a move up? Distribution. We now have used accumulation locally, day to day, and we are now using it on a bigger time frame, on a bigger scale. So now we are looking at this wedge and saying, well, we're in accumulation, and there's only so long this accumulation can go on before this wedge finally decides to snap and give out. Okay, so let's see what happens now. And you guys probably already know what's going to happen, but just to tie in all of these theories together, right? Comes, looks like it's trying to break out of the wedge there. Its accumulation is happened all here. Well, what's going to happen next? You can't make it up, guys. It's the science of trading. It's why things happen in the market. The second it breaks out of the wedge off long-term accumulation, look what happens. And let's further this move and see what happens. You know, it tries to break this level. It establishes first touch, first test, right? Has a retracement, establishes another test, and then moves. And look where it stops. It actually stops right on the level. So it actually stops right on the level of where we were thinking, which kind of enters this distribution zone that we had in the past. Oh, that's it. Okay, so that's where we are in the move right now. So you guys can kind of see the difference between trend lines and wedges, because trend lines are static, but wedges evolve. Wedges are trend lines, but they're evolving trend lines. They are not the static trend line, they are the dynamic trend line. And the important concepts to know with wedges is how to evolve them, what it means when they break, right? What that sideways break means. And if we just kind of drag through this again, right? It would have been the swing high to the swing low, right? Looks like swing high, swing low, right? Creates a new one right there. Oh, right, because we have this swing low here. My mistake. We have this swing low to that swing high, right? At that point, we created a new swing low, right? So swing low to swing high. As it breaks out, it goes up. And look what this ends up being, an accumulation zone from back here, right? So as it breaks up, it goes out. We then evolve our wedge from that swing low to that swing high. It breaks out, it takes a little move. We then evolve it. That swing low to that swing high. It comes up, it has kind of this last little bit of failure, creates a new swing low and a new swing high there. And then it finally has its move after it's done its run and accumulation. So you can see how it evolves and the importance of these wedges. And, you know, again, just to go over it, maybe now you guys can see that the type of wedges you guys are drawing, and you can look at these charts online and you can understand patterns and have this page where you have, what does an ascending wedge look like? What does a bear flag look like? What does a bull flag look like? What is a descending wedge, a falling, a rising wedge, a flagpole? You can have all these different forms of wedges. You can have all these different forms of trend line and wedges, but really the only thing that matters in all of that you see is the trend lines and the wedges. And all the wedges are dynamic trend lines, and all trend lines are static trend lines. So really everything is trend lines. And in trend lines, that's why we call it patterns, because wedges and trend lines are patterns. They are patterns that happen over and over and over on the market. And you don't, like I said, destroy that mentality of I need to memorize what an ascending wedge does and what it's going to do, because the mentality of all these wedges is really just the hard edges. And as we were up here, right, this would have been classified as your classic, I'm going to move the screen over but so you guys can see here. This would have been defined as your classic rising wedge. But what good is it doing you to memorize a pattern when you can understand why something breaks? It breaks because the price is being pushed sideways, and when it breaks that level of support, right, this is support, and that's why it's bouncing until a point where it either has to go up or down, right? You can see it right there. You can see it has to, it bounces so many times. It comes to this point where it absolutely has to break out of the top, and it tries to break out, it fails, it rejects off a level, and then all it has to do is move sideways. And once it moves sideways, it breaks. You don't need to memorize the pattern of what's going to happen, because memorizing that most of the time this ascending wedge moves sideways out of it is going to fall isn't going to help you if this breaks up. Because then what's going to happen? Then you're going to have this break up and move up like that. It's not going to help you because you've memorized one pattern, but really there's a certain amount of dynamics that can happen within this wedge, right? It can break up or to the right. The important part of understanding wedges, like I said, it's not pattern and memory recognition and muscle memory of to what they do. It's understanding why the wedge is there and why something is moving as it is, right? So very important lesson in wedges. You know, and then this is an ascending wedge, and then this is a different kind of wedge here, and you know, it would have actually, you know, been this here, this swing low to this swing high, and then it, you know, let's get it done properly. Would have been like that. It breaks out of the wedge, right? All it has to do is move sideways, and it moves up, right? You move it over again, you know, beating this thing to the last pulp, right? Bottom side of the wedge, top side of the wedge, breaks off the top side. This then acts as support. It takes its move up. It gets rejected on another level. Comes down here and is now trying to stay above this level here. So it just all ties together. Trend lines, patterns, levels of support and resistance, daily levels, weekly levels, monthly levels. This stuff all ties together in a very specific way. So really the science of things, right? And what do we have left? Wedge examples. Well, we went over that, but maybe let's quickly go over one more on key. Because I brought that example up earlier where this this coin took this rapid move on, where was it? The 18th is where I gave entry. So let's just cut it off at the 18th. So let's kind of go through my mindset and my process on this coin. And I have some levels marked out already from before. And you guys know that my strongest level here is my monthly level, which is the top side of the swing low candle, right? So monthly is silver, weekly is purple, daily is red, just so you guys can, you know, follow along quickly. And let's see kind of where I got that move from and walk through my thought process as if we were in the move still, right? So we are going to cut this off. Oh, bring our replayer back up. Pick our candle tool and go to the 18th because that's where I gave signal. Cut it there. Okay, let's create this wedge. So from the move that started the move down to the swing low, right? We had the wedges here. So let's walk through this, right? This would have been our first falling wedge, as they called it. Well, look what happens. Falling wedge, all we have to do is hold price up. We break out sideways, right? Classic example of what a wedge does. We break out sideways. It acts as support. We move up. Let's find our new swing high, right? New swing high is there. This is our swing low still. Our new swing high is there. Well, look what happens. We move up. We break down on the bottom side of this wedge. Well, just like clockwork or magic or whatever you want to call it. The science of trading is what I call it. You guys can call it whatever you want. I've had some people in the Discord channel say it's magic. I just tell them it's just the way things work. It's the science. Watch the videos, you will understand and be able to do this all on your own. And most of you already can. You guys are good traders. You guys know exactly what you're doing. This just helps you guys refine your skills and put some of the things that you know to bed and the ideas. So this, you know, oops. Going back to this, swing high, break the bottom side of the wedge. Of course we go down. So now we have a new swing low here. So all we're going to do is drag this out and create our new swing low and our new swing high. So you can see this wedge has actually evolved into a few different types of wedges throughout this move. At first it was a falling wedge or a descending wedge. Oh, sorry, at first it was a falling wedge. Now it's a descending wedge. So again, whatever the type of wedge is, it doesn't matter. It's not muscle memory. Now, let's go back to, before we move in further into this, what does this look like here? Accumulation. What does this look like up here? Distribution. So we're going to just mark this zone off here as kind of accumulation. And we'll just go to where the swing low of that candle was. And we'll just kind of mark out an area. That's not, you know, the exact science of marking out accumulation, but that just gives you guys an idea of that's accumulation there. So we know that if this is accumulating here after it's gone through long-term distribution, if it's accumulating on this level, you know, we can use that as a pretty good indicator and a pretty good strength with our wedge to see what's going on. We break out sideways, we take another move up, right? So let's expand it further. We break out sideways, we take another move up. You see, let's expand this wedge. Oh, like that. Let's expand this wedge further. And this is where I gave entry on this wedge as it's evolving. We have a swing high here, right? We have our swing high. This is a swing high too, but this is the highest closing candle, so I use that. We'll get into that in another video. For now, just use the swing high of the highest closing candle. So you can see this is where I gave entry on this coin, and let's see what happens. Kind of stays in between these levels that we have here, right? And it's probably not really going to move, and it's not really going to move until it breaks out of this wedge. But you can see here it's kind of gaining momentum, and at this point, let's zoom in and look at this. Not only do we gain, well, we don't gain this level, but we are starting to close over top of it. We gained the wedge here. This is where we gained the wedge on this candle. We haven't gained this level yet, but we've gained the wedge. That is going to give us the momentum we need to move up, right? Let's see what happens. The next move, just like magic, the first candle we close over this wedge, look what happens on the very next move on the daily. Just like magic, man, the science of trading. Boom, it moves up and it takes this rapid move up. And now, was this just luck, or was this accumulation and distribution with the concept of wedges, right? I'll let you decide. I know what it is, so I'll let you make your own decisions, and then let's see what happens, right? It's constantly going up out of this wedge. It's made its move, it retraces, and look what it does. And we identified a monthly level there, right? That was a pretty important point, and we are all caught up. So if we go back to the monthly levels, I'm going to always give you guys these examples, and you guys are going to constantly see me go through this, and just to hammer that point home of levels of support and resistance and wedges have an exact science. This is the reason that things happen. There is no guesswork. There is no maybe the level is here, maybe the level is there. No, there is one spot where that level is, and it is respected to the T, like 99% of the time. So we have a swing low candle, and like always, we would take the top and the bottom side of this. Let's mark out the bottom side as well, just for unity in this chart. So we have the monthly low and the monthly high level, right? And it's not every single month has a level. It's our swing high and lows, right? So, and if you're not grasping that, just go back to the levels of support and resistance video, and it goes over it in great detail. And you can see that we go to our replayer and chop this back off right here while we're in these levels, right? After we've broken this wedge, while we're still in the levels, right? After we retrace, we gain the momentum off the offset of, we offset momentum, we gain that, and look what we do. We touch the monthly level. It's just as simple as that, guys. Just as simple as that, right? And now it looks like we are finding support off this daily level. So we'll see where key goes from here. But having entry at 88 sats, because you can see a wedge about to break, a long-term wedge about to break that's been tested and kind of evolved multiple times. Kind of the more times a wedge evolves, the more times a wedge has to be pulled out and redrawn. Becomes this point where every time you're evolving that wedge, it's becoming weaker, I guess is the best way to put it. Those support and resistance lines are becoming weaker. So every time you're pulling these wedges out, and every time it's tested it to break and made a new swing high and a new swing low, or any type of swing movement off the break of a wedge, every time it does that, it kind of weakens the wedge, right? Almost think of it like first touch, first test, second test, all that, right? It's the same thing. It's testing those wedges. And we'll get into that in a more advanced video, but I think you guys can see where that first touch, first test theory is starting to come into play, as you're touching the level and it's becoming different every time. And it happens with wedges and trends too, right? So let's quickly go back over the list here and see what we haven't covered. Okay, what are wedges? We know what wedges are. They are akin to trend lines, and they end up being kind of just the complete, the dynamic trend lines versus the static trend lines, right? Static is your trend lines, dynamic is your wedges. Two different things, although they are the same concept, right? Swings to swings, that's all it is. It's a pattern, right? You can lump that into one concept, patterns, right? Wedges and trends, patterns, is all they are. Forget everything else forget bull flags, pendants, this, that. I don't use any of that. You guys shouldn't either, because now you can see all you need is levels and patterns, and that's it. Everything else is just quick tools that people use who don't quite understand the what and why, right? What purposes do wedges serve? The dynamic movement of trend lines, accumulation and distribution in wedges. You can see that there's accumulation and distribution in wedges, just like there is in levels, just like there's in all charts. How do they differ from trend lines? We answered that one already. What happens on a wedge break? As a wedge breaks, it's forcing a move. It's forcing a point where there's going to be action of some type, up or down, based on how that wedge is breaking. And wedge examples we went over, I think, in pretty good detail. So I think that's it for this one, guys. This has been Beginner's Course Part 7 on wedges. Follow the channel, check out the donations, do all that fun stuff we talked about in the beginning of the video, and take care. See you on the next one. Bye.